So we're going to be looking at the breakout block candlesticks that are actually violated or breached kind of order blocks. So what we can see is we have this movement of price to the downside. So basically we are having a downward movement of price. So we have the impulsive move, we have the pullback, price pushed to the downside, and then we can see that price took out this low. And now what we can see is that we're still expecting a pullback and then bearish continuation. But what we're going to see is the market will push to the upside and then raid or break through this swing high points, leading to a market structure shift. It can be a major market structure shift or a minor market structure shift. So basically, the breakout block is actually a sponsorship candle that actually takes out a previous swing low in a bearish market condition, and then price gives an impulsive or expansive leg move and then takes out the swing high that actually took out the swing low. So this could be a value break of structure, or this could be price just actually raiding liquidity with a wick. So basically the breakout block takes out sell side liquidity and then creates an impulsive move that breaks the previous structural swing points that actually took out the sell side liquidity. So that is when we can now actually identify the breakout block. In this example, this is a bullish breakout block. So now, because we can see that now we have this impulsive move to the downside, which is bearish, took out this low, but then price gave us this leg move to the upside that took out this high. So we are expecting to see bullish market condition, because now price took out the swing low points that sponsored these low points that broke structure or just took out liquidity with a candle wick, and then price gave an impulsive move that took out the previous swing high points. So basically, when you look at this other image or diagram here, you can see that what I'm trying to explain is to tell you that the market will give us the impulsive move, the pullback. Price created the swing high. The swing high sponsored the move that took out this swing low, either with a valid break of structure or just raid the liquidity with wicks. And then we can see this impulsive move that would now actually break through the swing high points. So this is where we have the bullish breakout block. What we're expecting is to see the pullback, because this is actually a bearish order block, where we're expecting to see that price will pull back, mitigate the bearish order block, and then continue the movement to the downside. But then we would see that price give an impulsive move and then broke through the bearish order block. So the bearish order block is going to actually reclaim price and then push price to the upside. That makes the bearish order block now a bullish breakout block. So what we can see is, what I'm trying to say is this. You can see we have this bearish movement to the downside. Price gave us the bullish move, pullback. Price gave us now the bearish move to the downside. We have this break of structure because we can see candle body close below this swing low points. So you can see we have our bearish order block. We know we are in a downward market condition. So we have our bearish order block. This is the last up close candle before the bearish move to the downside that took out this swing low point. But then now we can see that the institution actually now pushed price to the upside and then took out the swing high points that took out this low point. So the expectation was to actually see the return to the bearish order block and then price continuation to the downside. But then price broke through the bearish order block and closed above the bearish order. So this break of structure is actually a market structure shift. So it is leading to a reversal. So the market is no longer bearish. The market is looking forward to becoming bullish, because now we have this candle closing above the last swing high point that broke the previous low point, took out the sell side liquidity. And now price gave a bullish move that took out that swing high points. So price now creates a bullish breakout block. So the bearish order block becomes a bullish breakout block when price breaks above the swing high points. So how you actually want to trade these breakout blocks is actually to see a confluence of fair value. That helps to actually make the bullish breakout block or the bearish breakout block a solid breakout block to actually look forward to take entry from. So we could see the scenario where price may not have to necessarily leave a fair value gap beside the breakout block. But the ideal breakout blocks you actually want to be trading is the ones that actually leave a displacement beside the breakout block. So now we can see that price gave us this fair value gap. We have this displacement to the upside, broke the high left fair value gap. So we can expect to see price return, which is actually what you're seeing here. So we can expect to see price return to fill the fair value gap, mitigate the bullish breakout block, and then we have price push to the upside. So this is an example of the bullish breakout block. The bullish breakout block is actually a violated bearish order block. So this is an example here in the chart. You can see we have this bearish market condition to the downside. Now we can see price gave us the swing low points. Price pullback, took out liquidity, created this swing high point. Now you can see that this point of the movement to the downside that took out this liquidity. You can see here we do not have a break of structure. We have price took out liquidity. So that is why I told us that once the breakout block would actually sponsor the break of the swing low or just the rate of liquidity. Now we can see this condition, we have the rate of the sell side liquidity. And now we can see this massive displacement to the upside. Price left this fair value gap. We have this order block, the last down close candle before the impulsive move that took out the swing high points. So our expectation is to see a pullback to the downside. To mitigate the breakout block, this is the breakout block because this is now the last up close candle before the bearish move to the downside that took out sell side liquidity. So this is where we now have our bullish breakout block, and you can see the confluence of the fair value gap. So we're expecting the fall of price to mitigate the fair value gap in confluence to the breakout block that sponsored the movement to the downside that took out sell side liquidity. So you can see the bearish order block is now a bullish breakout block because price pushed to the upside and broke through it. It sponsored the move to the downside that took out liquidity, left fair value gap, and was violated. So we're expecting a pullback. We're expecting to see it reclaim price to the downside. Now you can see our price return to the downside into the fair value gap in confluence to the breakout block. And if you can remember in the fair value gap episode, I told us the price may not necessarily have to fill up the fair value gap in totality. So we can see this is the last up close candle before the bearish move that took out liquidity. Now price gave a reversed movement that broke through the high, created fair value gap. Now we can see the fall into the fair value gap in confluence to the breakout block. And then we have price push to the upside. So this is what you should know about the bullish breakout block. We're going to look at more examples in coming episodes. So now let's actually look at the bearish breakout block. Now for the bearish breakout block, we're actually in a bullish market condition. And then price creates the last down close candle that sponsored this bullish move to the upside that takes out the previous swing high points, either with a valid break of structure or with a rate of liquidity candle wicks. And then we can see that price will fall to the downside and then price will break through the swing low points, leading to a market structure shift. So we're dealing now with the bearish breakout block. So the bearish breakout block is actually a violated bullish order block. So we can see that price gave this bearish movement, created the last down close candle, and then price created a bullish movement of price to the upside that took out the previous high points, either with a valid break of structure or with a rate of liquidity through the candle wicks. Price returns to the downside and then breaks through the swing low points. So we're expecting to see that price will pull back. So the breakout block will reclaim price. Price will pull back, mitigate the breakout block, and then we have price continuation to the downside. So you can see we have the bullish breakout block and we have the bearish breakout block. So now what we can see from the candle example is this. We can see this is the bullish move. Price created a pullback. We have our bullish breakout block. This is our last down close candle before the bullish move of price to the upside that broke through this high. But then now we can see that the institution sponsored a bearish move and broke the swing low points, leading to a market structure shift because you can see that this candle body closed below the swing low. So you can see that the bullish order block is now a bearish breakout block. So our expectation is to see the pullback to the upside for price to mitigate the breakout block, and then we have price continuation to the downside. The ideal expectation was to see that price will break the swing high, take out the external range liquidity, return to mitigate the bullish order block, and then price continues to the upside. What we can see is that price returned to the downside and broke through the swing low, creating now a bearish breakout block. So since the bullish order block did not actually sponsor for the push of price to the upside, it is going to reclaim price and then send price to the downside, which is now acting as a bearish breakout block. So the breakout block takes out the previous swing high or read liquidity, takes out the previous swing high by actually value breaker structure or by just actually taking the liquidity with candle wicks. So now what we can see here is actually a chart example where we have this bullish movement of price to the upside. And what we can see, we have this pullback to the downside. And this is the last down close before this bullish move that took out this high. So meaning this is our bullish order block, because this is the last down close candle before the bullish move. And then price took out this swing high point. So we have the rate of this liquidity, not really a valid breaker structure. So we identify this as our breakout, the last down close candle before the impulsive move that took out this buy side liquidity, this previous swing high points. And now we can see the displacement, and then the displacement broke the previous swing low points. Now we're expecting to see that price will actually return through the breakout block. Then we have the continuation of price to the downside, because what we can see is this displacement filled up this value gap left here. What we have is this sell side liquidity. We have this inefficiency. So the market is being drawn to this inefficiency in the market. So we want to see price pulls back and then falls to the downside. And that is what we can clearly see here, that the market pulled back into the breakout block zone, the bearish breakout block zone, because we have price took out this high, give the displacement, took out this low, candle body closing below the low, the pullback into the breaker, and then the fall of price to the downside. You can see how price filled up this inefficiency, and then we see how furthermore fall of price to the downside. So this is the bearish breakout block, and you've also seen the bullish breakout block. So let's also look at another example here. We have this movement of price to the upside. Price gave this valid pullback, and then price gave this impulsive move that took out this buy side liquidity, that took out the external buy side liquidity, that took out this swing high points. And then you can see we have the displacement that took out the low points, that sponsored this movement that took out this high points. So where's the last down close candle that sponsored this bullish move? So you can see within this retracement line, this is the last down close candle that sponsored this bullish move that took out this high. So meaning this is our breaker block, our bearish breaker block. So we have this as our bearish breaker block. So our expectation is to see that what price will return to fill up this fair value gap from this candle high to this candle low. Is where we have the fair value gap. In confluence, you can see we have the breaker block. So we're expecting to see a pullback for price to retest the breaker, and then we have the fall of price to the downside. And as I've earlier said, that the market may not necessarily have to fill up the fair value gap. So let's see. Now we can see that the market actually returned to the upside. So we can see that actually price mitigated the fair value, but did not fill up the fair value. So if actually we were looking forward to take our entry from this particular zone, maybe at this particular price level, we can see that price not really returned fully into it and then falls to the downside. Price actually returned and mitigated the fair value gap before falling to the downside. So in the coming episode, we're going to look at more advanced sponsorship candle. We're going to talk about the inversion fair value, because it is a concept of the inversion fair value that actually influences this movement to the downside without further pushing into the breakout. So this is what you should understand about breakout blocks. So we're going to look at the mitigation blocks. So the mitigation blocks are also a form of order blocks that gets violated. So what we can see, the difference between the breakout block and the mitigation block is that the mitigation block do not actually read the previous low points in the condition of a bullish mitigation block, because we can see we have this downward momentum pullback. Price created the swing high, but then this swing high actually failed to take out the swing low. And then we have the push of price to the upside that took out the swing high points. So we now have a bullish mitigation block here because the expectation is to see this pullback and then price continuation. So we have price created this new high. We have price created the bearish order block. So the bearish order block failed to actually sponsor an impulsive leg move to raid the previous swing low points. And then now price actually pushed to the upside and then raided the swing high where we actually have the bearish order block. So the bearish order block is now going to act as a bullish mitigation block. So it's going to reclaim price and then push price to the upside. So you can see that the mitigation block did not raid the swing low. The breakout block actually rates the swing low with either value breaker structure or liquidity swing. So now we can see from the candle example here, we have the fall of price to the downside. Price gave us the bullish pullback. So you can see where we have the bearish order, the last up close candle before the bearish move to the downside. But then price failed to take out this swing low points. Then we have the push of price to the upside, and then price created this market structure shift. Now, in confidence in the market structure shift zone, which is the bearish order block, which is now our bullish mitigation block, we're expecting to see a fair value gap. Price would now return, and then we see the push of price to the upside, which is actually what we are seeing here. Price will pull back, and then we have the push of price to the upside. So I said price may not necessarily have to leave a fair value gap in confidence to the breakout block. But for high probability, you want to see fair value gap in confidence to the breakout block or mitigation blocks. So now we can see that now in confidence in the mitigation block, price left the fair value gap. Price dropped to the downside, and we have the push of price. That is the expectation, because the bearish order block actually failed to break structure and it was violated to the upside. So now what we can see is a chart example here. We have this movement of price to the downside. Price fell, created this high, fell, price pushed to the upside. Now we can see price created this high point, took out this liquidity. So we're expecting to see that price will further push to the downside to raid this low point since we're in a bearish market condition. But what we can see is that now price actually failed to continue the downward movements to take out the swing low points. So what we can see is we now have to identify the last up close candle before the bearish move that failed to break the swing low points. So we can see this is the last up close candle that sponsored the bearish movement to the downside that failed to actually take out the swing low points. And then price pushed to the upside and violated the swing high points where we actually have the mitigation block. So now we have the words bullish mitigation block. But in this case, you can see that beside the bullish mitigation block, you can see that price actually returned to mitigate that as the bearish order block. And then price wanted to fall to the downside, but then price pushed to the upside. So we can see this created a form of a flip-flop, meaning price gave us a bearish order block, and then price now created a bullish order block here. So now we can now see that this is also a form of a confluence because the bearish order block zone created a bullish order block zone, and we can see a fair value gap here. So we can expect to see a push of price to the downside and then continuation to the upside to take out this liquidity, fill up this inefficiency. So, and that is what we can now see happen here. Price return to the downside. We can see mitigated the fair value gap because we have the order block. So price return to the mitigation block, which establishes another confluence of an order block. Then we can see that price return mitigate, and then we have the push of price to the upside. So now, we're now going to look at another example. You can see we're having this bearish movement price to the downside. Price gave us this pullback. Price failed to push to the downside to take out this swing low points. Now we can see this push of price to the upside. Price took out the swing high points. So you can see this is the last up close candle before the bearish move to the downside that actually failed to take out the swing low points. And you can see we have fair value gap beside the mitigation block, the bullish mitigation block. So we're expecting to see a fall of price, and then we see price push to the upside. You can see this is our mitigation block because it is the last up close candle before the bearish move, and we can see fair value gap here. So now we're expecting the fall of price, and then we see price continuation. And that is what we can actually see here. So we can see how price return, filled up the fair value gap, price pushed to the outside, price filled up this fair value gap, and then still decide to fall back to the downside before pushing further to the upside. So this is actually how you now identify the bullish mitigation block. It is actually a violated bearish order block. So for the bearish mitigation block, what we can see is that price pushed to the upside, we have the pullback. So price created the swing low point. We're expecting an impulsive move to take out the high, but then price failed to create that impulsive move to take out the high. We actually have a bullish order block here. So the violated bullish order block becomes the bearish mitigation block. Since price created the bullish order block and then failed to actually take out the swing high, and then price actually dropped to the downside and violated the bullish order block, now acting as the bearish mitigation block. So we want to say reclaim price and then push price further to the downside. So this is actually a candlestick example to that to explain it clearly. We have the bullish move, we have the fall. Price created the bullish order block. Price pushed to the upside, failed to take out the high. And then we have the fall of price that took out the swing low, leading to a market structure shift. So we're expecting to see in confidence the fair value gap and the bearish mitigation block. We want to see price return, mitigate, and then falls to the downside. So we're going to look at more advanced theory to this. So you can see this is a price to cut the swing low. So we're expecting to see push to the upside, mitigate the fair value gap and the bearish mitigation block. And then we have price continuation to the downside. So this is a real-time chart example. We can see the bullish move to the upside. Price gave us this impulse. We have this pullback. Price pushed to the upside to cut this high, fell to the downside. Price now pushed to the upside, failed to break this high point. So you actually want to identify the last down close candle before the bullish move that failed to take out this high, because we're in a bullish market condition. And you can see this is the last down close candle. And in confidence to that, we have this fair value gap. Price gave us the push to the upside, failed to break the high. Price gave the displacement to the downside and then broke the low points. So we can see that price is targeting to take out this sell side liquidity, fill up this inefficiency. So our expectation is to see what pullback. So you can see we identify the mitigation, the bearish mitigation in confidence of this fair value gap. And now what we can see is price return to the upside, filled up the fair value gap, mitigates the mitigation block zone, and then we can see how price fell to the downside. Price filled up this fair value gap, pushed to the upside, returned to this fair value gap, and then fell to the downside.